Welcome to The Explainer. We're tackling a massive topic today, one that really sits right at the very heart of the Canadian economy. We are going to completely demystify the world of business funding and heavy equipment financing for industrial operators across the country. Look, if you're running a capital-intensive business, anywhere from the busy streets of Toronto to the remote resource hubs of Northern Ontario, understanding how to strategically fund your operations isn't just a nice-to-have skill, it is absolute survival. So get ready because we are going to break down the exact tools available to keep your machinery running and your business growing. Okay, let's dive into this. Here is our roadmap for today. We're breaking this down into 5 manageable chapters: the cost of doing business, the power of private leasing, specialized industry financing, government-backed growth programs, and finally, a real-world expansion success. Chapter 1, the cost of doing business. Let's talk about navigating those economic pressures. To really understand why strategic financing is absolutely critical right now, we have to start with a massive question. How do you grow an industrial business when the equipment costs more than your current revenue? In heavy, capital-intensive operations, think forestry, mining, or heavy transport, even a single piece of specialized machinery requires a huge upfront investment. You simply cannot rely on your everyday cash flow to just go out and buy a fleet of forestry harvesters or mining rigs outright. It doesn't work that way. And man, that capital challenge is really being compounded right now by some major macroeconomic headwinds. The Thunder Bay Chamber of Commerce has documented how Canadian businesses are navigating this incredibly shifting trade landscape. We've got the upcoming review of the Canada-United States-Mexico Agreement, or CUSMA, and we're also seeing significant external pressure from U.S.-Canada trade tariffs, specifically targeting steel, aluminum, and copper. When the raw materials used to build heavy machinery get hit with tariffs, the upfront capital requirements for that equipment naturally just skyrocket. Now, we aren't here to take a political stance on trade policies, but we absolutely have to report on them as critical economic variables. They're the driving force behind this urgent need for smart, strategic financing. To counter some of these specific trade disruptions, we are seeing some major public responses. $1 billion. That is a massive number. It represents a newly announced program from the Business Development Bank of Canada, or BDC. This billion-dollar fund was launched specifically to support manufacturing firms that export products containing steel, aluminum, or copper and have been directly impacted by those tariffs. It's a huge lifeline for sure, but as you'll see, government funding is just one piece of a much larger financing puzzle. Chapter 2, the power of private leasing, preserving your capital. And this brilliantly illustrates the distinct contrast between our two main financing avenues. On one side, you have private leasing, which is all about agility. It gives you speed, highly flexible terms regardless of your credit quality, a specialized focus on your exact industry, and most importantly, it preserves your daily working capital. On the other side, government programs offer incredible scale. We're talking larger funding caps and risk-sharing models, but they come with highly rigorous, strictly scheduled application processes. Both are totally vital, but private leasing is usually the immediate fuel businesses reach for to stay competitive day to day. Private lenders, think places like Money in Motion and Dollastone Assets. They provide simplified budgeting with steady monthly payments. Honestly, that is a total lifesaver in unpredictable industries where weather or commodity prices are just bouncing all over the place. They offer tailored plans whether you're sitting on a lot of upfront capital or very little. Another huge advantage here is efficiency. Forestry and mining equipment wears out incredibly fast. Leasing gives you the power to upgrade to newer tech without blowing all your profits repairing outdated machines you already own. Private lenders even offer really creative solutions like accounts receivable financing, literally giving your cash based on your future invoices, or sales leaseback programs. The whole goal, the entire shebang, is preserving your cash flow. Chapter 3, Specialized Industry Financing, finding solutions tailored right to your terrain. This is where we see how private lenders adapt to the highly specific, genuinely grueling needs of Canada's massive resource sectors. Standard bank loans, they often just don't get the nuance of heavy machinery, but specialized lenders absolutely do. Firms like Guardian Leasing have built their entire models around these core Canadian industries. They actually have dedicated specialists covering mining, forestry and milling, farming, and oil and gas, and they are physically focused on the regions where this hard work is happening. Their mining specialists are out there covering vital northern regions like Sudbury, Thunder Bay, and the Ring of Fire. Meanwhile, their forestry specialists are active all the way from Kapuskasing to Sault Ste. Marie. They understand the terrain and they understand the business cycles of the clients they are funding. Now, what's really interesting about this is the sheer variety of niche assets that can be financed. Basically, if it has a serial number, these specialized lenders will usually consider it. We're not just talking about your standard yellow iron here. We're talking about highly specialized forestry attachments, mulchers, feller bunchers, and skidders. We're talking about heavy-duty towing equipment and even specialized automotive recycling setups. They provide this leasing regardless of standard credit quality because they understand the intrinsic value of the asset itself and its real revenue-generating power in your specific industry. Chapter 4. Government-backed growth programs. Expanding with regional support. But hey, what happens when you want to scale the business itself, not just lease a new machine? Well, let's pivot back from the private sector to explore some of the massive public safety nets available for businesses looking to expand their operations, their facilities, and their workforce. A really foundational tool here is the Canada Small Business Financing Program. It makes it significantly easier for small businesses to get loans from financial institutions. How do they do it? By the government stepping in and sharing the risk with the lenders. The limits are clearly structured. You can access a maximum overall loan of $1.15 million. Within that bucket, up to $1 million can be used for term loans. If you need to buy new equipment or improve a leased property, up to $500,000 of it can go there. And crucially, a maximum of $150,000 can be used for intangible assets, working capital, and lines of credit. It is a fantastic, highly structured risk-sharing vehicle. Let's move on and see how this builds with the Invest North Grow program run by the Northern Ontario Heritage Fund Corporation, or NOHFC. This is specifically designed to assist existing businesses in Northern Ontario to scale up. They offer 3 distinct funding tiers. Tier 1 is a conditional contribution, which is essentially a grant, covering up to 20% of eligible costs, maxing out at $400,000. Tier 2 is a hybrid option. You can get that same 20% grant up to $400K, plus a loan covering another 30%, all the way up to a $600,000 limit. Finally, Tier 3 is a pure term loan that can cover up to half of your project's eligible costs, all the way up to $1 million. It's incredibly robust support if you're looking at building construction, upgrading your spaces, or buying heavy equipment. But remember earlier when we compared this to private leasing? Government programs have a very rigorous structure. The NOHFC application pipeline works in strict competitive rounds. First, you apply with your business plan to make sure you meet the guidelines. Then comes a detailed evaluation phase, and finally, a decision by their board of directors. The catch here is that these applications are evaluated in 4 specific rounds throughout the year, with hard deadlines at the end of January, April, July, and October. You can't just walk in on a Tuesday and get funding by Friday like you might with a private lease. You have to strategically plan your entire expansion around this pipeline. Chapter 5, Real-World Expansion Success. Let's look at Final Drives Canada. To truly understand the impact of all this, let's bring these abstract financial figures back down to earth with a tangible, local success story right out of Northwestern Ontario. $78,080. That is the exact NOFHC grant recently awarded to a company called Final Drives Canada, based right in Thunder Bay. They are a distributor of critical parts for mining, construction, and forestry equipment. This targeted investment by the Ontario government was designed specifically to give them the exact tools they need to grow and become way more competitive. So, the crucial point is how this money is actually deployed on the ground. Final Drives Canada isn't just letting this sit in the bank. They're using it for a major operational overhaul. They acquired and updated a new space to expand their warehousing and shipping capacity. They're investing in new equipment, updating their manufacturing stations, and totally overhauling their IT systems. This allows them to offer more products, reach brand new markets, and most importantly for the local economy, create new, good-paying jobs. I really want to highlight this quote from Kyla Jarvinen at Final Drives Canada because it perfectly captures why this stuff matters to everyone. She said, by stocking essential components in Canada, we help create a dependable supply network that minimizes downtime and keeps heavy equipment working here where it's needed most. Think about that. When local distributors get the financing they need to stock parts locally, it means the forestry harvester or the mining rig we talked about earlier doesn't have to sit idle waiting weeks for a part to cross an international border. Regional financial support strengthens the entire local supply chain, and that protects jobs across multiple industries. And that brings us to the end of our explainer. But I want to leave you with one final thought. Look at your own operation right now. Which financial toolkit is going to fuel your business's next massive leap forward? Will it be the agile, capital-preserving power of private equipment leasing to get that new harvester immediately out into the field? Or will it be a structured, government-backed growth program to build out your brand new warehouse? Or perhaps a strategic combination of both? The tools are out there, literally waiting to be leveraged. Thank you so much for joining me today, and keep building.